what we say in terms of the forecasts, and President Lagarde came back to this morning, is there's a long way to go. So going from where we are now all the way to our target in our forecast will take a couple of years. And so this is really, if you like, a phase where the original shock in terms of energy, in terms of pandemic, in many ways they're behind us in terms of the original shock. But now we are in this, if you like, adjustment phase. And that adjustment phase where wages need to catch up, where there's ongoing price adjustment across the economy, will be a gradual process. And critically, in order to make sure it doesn't take too long, and in order to make sure it doesn't become embedded indefinitely, this is why we say we need to move monetary policy to sufficiently restrictive levels for sufficiently long.
I've been speaking to many central bankers here on the ground in Sintra, and the general message is actually quite clear that the cost of overhiking are not as high as the cost of not doing enough. Because clearly if you don't do enough as a central bank, you'll be confronted with a much bigger problem at some point in time in the future. And that is why people here are really concerned about these second round effects. That's what he was referring to as the second phase of the inflationary environment. That is where we're in right now. Energy prices are coming back, commodity prices are coming back, but what we're seeing now is second round effects through wage effects, for example, but also service price inflation is driving prices higher, and that is possibly also the case during the summer period. So I guess the trajectory of monetary policy, if not being very clear, but it's quite clear that they're going to hike at least once or twice again after the summer break. Perhaps we listen of what Philip Lane said about monetary policy implications of that higher than wanted inflation rate.
What you need to allocate is essentially how the market prices risk. So in terms of their true expectation of what we might do, versus some risk factors. But let me differentiate between the longer end of the yield curve and in many ways having lower yields 5 years out, 10 years out is a sign of confidence that inflation is temporary. We will get back to 2% in a couple of years, and once we're back at 2% or on our way to 2%, then easing will happen. So that is, I think, uncontested. Where I do think the market should ask itself questions is about the timing or the speed of reversal of the restrictive policy. Because essentially what I'm saying to you, and it's the general message here, is essentially we will not be back towards 2% for a couple of years. We will make good progress even this year, especially at the later part of the year. But it's not going to collapse to 2% within a few months. And so we will have a sustained period where rates need to remain restrictive to make sure we don't have any new shock that takes us away from 2%. And that's, I think, the durability of restrictiveness is very important. So anyone who thinks we're pricing on the latest inflation number as opposed to looking at the whole horizon of monetary policy over the next couple of years. And when I look at the horizon for the next couple of years, I don't see rapid rate cuts, priced in, or I don't think it's appropriate to have rapid rate cuts priced in expectation. So maybe there's some risk story they can tell you.
Would you say that we also need, looking at the asymmetric inflation target, an undershooting of inflation?
Well, I mean, I think in our strategy review, we were clear that we have a symmetric target. We're clear, we're guided, which I think is very helpful, by the way, in today's conditions, to be clear that we will go for our 2% target. It's also clear, as you know, we take a medium-term view. It's not the case we need 2% every month, but we need to make sure the system is essentially, whatever may move it away from 2, we go back to 2% quite quickly.